I've looked at thousands upon thousands of charts, and I've broke down market structure into these 3 steps. First, we're going to be talking about weak points of market structure as well as strong points of market structure. Then we're going to be talking about short-term lows and intermediate-term lows, or intermediate-term highs and short-term highs, as well as we're going to be talking about market structure shift. I believe these are the 3 basic fundamentals within market structure that can tell you whether price is going to respect this high to go lower, or whether we're currently in reversal to now go from lower to now higher prices. I'm going to simplify this in a way that anyone who watches this video is going to understand, and it's going to help you greatly along your trading journey. If you guys want to get the most value from this video, I urge you guys to grab your notebook, some notes, as well as watch till the end, because I'm going to give you guys everything that you need. Now let's get into the first lesson. First lesson, we're going to be going over short-term highs and lows, and it's pretty simple. Short-term high is when we have 3 candlesticks, a candlestick to our left, a candlestick to our right, a candlestick in the middle. And the short-term high is represented by this high point right here. Is the high that's higher than the high to its left, as well as the high to its right. So obviously we would classify this as a short-term high. Vice versa for a short-term low. You can see the candlestick in the middle is lower than the candle to its left and the candle to its right. Now that we classified our short-term low and our short-term high, this gets us into our next lesson, which is intermediate-term highs and lows. Intermediate-term high is when we have a short-term high that's above the short-term high to its left, as well as the short-term high to its right. It's the same concept for an intermediate-term low. It's when we have a short-term low to its right and a short-term low to its left. This is the basic general gist of market structure. Intermediate-term highs and lows, short-term highs and lows, all of this will pair up as we get into our next lesson. This is to our next lesson, which is strong highs and strong lows. And there's 2 ways that you can trade this. First way that you can spot a strong high or strong low within markets is by utilizing a market structure shift during a reversal. And let me break that down very simply. So we can take note here of this original low right there. Higher, and then it eventually comes lower to take out that same low point. Classified as a liquidity sweep, where we can see price created that low there. It came lower and took out that low level, and then following that liquidity sweep, we see a strong push to the upside. This strong push to the upside, this is our market structure shift. From this liquidity sweep to this market structure shift, this gives us the general idea that price is currently in reversal. Price, after taking out this original low, it could not continue going lower, and instead it's now going to reach back above higher prices. Whenever you spot a liquidity sweep plus a market structure shift, this is then referenced as a strong low. And a strong low basically means that this is a level within the markets that price is not going to come back down into. And vice versa can be said for a strong high, where we have this original high right here. Price comes higher to take out that high point before then seeing that market structure shift lower. Obviously, this is a strong high, which we can mark out. If the market ever gives a pullback, as long as you can have a stop loss back over this high, you're safe. So I can take a short here, I can take a short here, or even take a short here, but as long as my stop loss is back up here, I should be safe to continue going lower. We classify it as a strong low versus a strong high. Next, we can look at weak highs and weak lows. So it's very simple. So we're in a downtrend where price is going lower and lower. Price is in a downtrend. Most likely these previous highs are strong highs, right? Every single time that price goes lower, it's respecting these previous highs. So these are strong highs within the market. And since we're in a downtrend, most likely these previous lows are what we call weak lows. A weak low, as well as this would also be a weak low. It's basically just following structure. As price is going lower, prices are going to respect these previous highs as strong highs, and it's going to disrespect these previous lows as weak low. So in this case scenario, price created this liquidity sweep followed by this breaker structure to the downside. This is a strong high point. And then we can see here that price came back higher to create a retracement back into a frame of entry, which we'll talk about later on. And then we see a drop to the downside. This is now our new strong high point, meaning after this liquidity sweep, when price came back below this low, that was a weak low, as well as when price gave this retracement, came back below this low, this was also a weak low. Whenever you're looking at market structure, you want to look at it from the lens of where are you currently at within the range. If price is currently in a downtrend and it's respecting previous highs, do not buy, right? At the end of the day, you don't control the markets. You have to pay attention to underlying market structure. If the market wants to go lower, you have to respect the current market conditions. Yes, price did go higher in this instance, but we have to take note that price is currently in reversal, where it took out this original high and then created this market structure shift. Even though price did go higher, it's simply just going higher to create a retracement to then continue going lower. I see a lot of traders, they get stuck on the lower time frames like the M1, and they see price start to see a shift to start pushing higher, not understanding the bigger picture. right? Market structure is understanding the bigger picture and riding the trend. You never want to go against the markets. You want to trade alongside it. And this is how you make a lot of money trading. Now that you understand all those concepts, now let's put this on a chart to where you can actually trade and start making money. And the first thing that we want to take note of is the time frame. When you're identifying market structure, I like to be on the 1 hour time frames. And the reason why I like the 1 hour is because it's not too large of a time frame like the 4 hour or the daily to where it'll take a long time to pan out, but it's not too short of a time frame like the M1 or the M5 to where you get faked out. Time and time again, I have seen that the 1 hour respects structure the most. So whenever you're marking out your market structure within the markets, you want to stick to the 1 hour time frame. As well as the next thing is time. So currently I'm trading the New York session between 7 to 12 p.m. EST. There's other sessions like the London session 2 to 6 a.m. EST. Then there's the Asia session between market open all the way until 12 a.m. EST. And 30 minutes before the New York session, I'm creating my daily buys and paying attention to overall market structure. The first thing that we can take note of in this example is the intermediate term high right here. And see, we have a short-term high right here to its left and a short-term high right here to its right. So coming into a New York session, I'm going to take note of that. So I'm going to mark this out as an intermediate term high. An intermediate term high, I'm going to mark it out as a strong high point, right? Because this is a strong level within the markets that I'm anticipating price not to break through. So as we can take note of this liquidity sweep right here to its left and take note of this market structure shift right here at the bottom. Have this liquidity sweep plus this market structure shift, right? Whenever you have a liquidity sweep and market structure shift, this last up close candle right here that took out this area of liquidity, that is referred to as our bearish order block. Take note of this last up close candle right here that took out that original high all the way back up into that strong high point as my bearish order block. So this is a resistance level within the markets. Case scenario, coming into the New York session, I'm paying attention to all fronts. We have a strong high point. Price is not going to break back over this high, but we have a order block right here. This is a resistance level. And right here, this is a short-term high. This case scenario, it's very simple. During the New York session, I want to see price open up, come higher, back within this level to find resistance to go lower. And see price come back higher within this resistance level and then break away from it. This would then give us a proper setup to continue going lower. Since we had this liquidity sweep and market structure shift, price is currently in a downtrend. So most likely this original low referred to as our weak low. Take note of this as our weak low. We can take note of this fair value gap down here as a level of inefficiency that price can come back down into. So this fair value gap is the separation between this first candle's high and this third candle's low. So obviously when price creates fair value gaps within the markets, price tends to come back down into them. We can mark this fair value gap as our draw on liquidity. Creating a daily bias is very simple. Where have we been? Where are we currently at? And where do we anticipate price to go next? Liquidity sweep and breaker structure to the downside. Currently in a reversal. Anticipating price to come back within this bearish order block to find resistance to go lower. And where am I targeting? I'm targeting back below this low and potentially down into that fair value gap. For coming into the markets, you want to create a daily bias just like this and keep it very simple. Now I'm going to go down to the 15 minutes time frame. I'm going to let this pan out. The 15 minutes time frame here, and I'm going to see what happens. Here price obviously opens up, comes higher. I am looking for lower prices. I'm most likely not going to take a long here. So we can see price comes back within that order block level. Right there, price ends up taking out that short-term high. But remember, did not take out that intermediate term high right there, which is that strong high. Right, this is also the same high that took out that area of liquidity before this break lower. So this is a very strong high point. It should not take it out. There, it came close. It came super close to taking it out. Saw it for a bit, and then we see a drop down. This is perfect, right? When you see this type of signature where you're inside of a level of resistance, let's see, we have a strong high up here. Price is struggling, right? This is what we call exhaustion. It reaches a level to where it's met a ceiling, where you can see it came up once, twice, 3 times, 4 times, 5 times. It could not break through it. Well, this is what we call exhaustion. That we see that we have exhaustion at these highs, which is inside of a resistance level. Price cannot break through this level no matter how many times it cannot break through it. And then we see a strong push to the downside. This gives me the idea most likely price is not willing to break through this level, and seeing this strong break lower gives me the confidence to frame a short. So as price is going lower, creating these consecutive last stop close candles, you can take a short anywhere within this range. You can take a short here, maybe a short here, or even down here, as long as you have a stop loss back over these highs. Too many traders focus on their take profits, right? You have to stop focusing on the take profits and focus on where you put your stop loss, because if you put your stop loss right here, you could get tagged out. If you put it right here, you could get tagged out. Or even if you put it right here, you could also get tagged out. But if you put it right here, you'd be safe. So where you put your stop loss is very important. So I'm gonna place my entry wherever here. So this is where this candlestick closes. So that's where I put my entry. And as long as my stop loss is back up here, I am safe. It should not break back over that level. And we can target back below these low points. Take note of this fair value gap down here, which yields us a 2-to-1R, which is more than fine. But if you want to go for like a 3-to-1R, then obviously down here at these week lows, that's also a level. So I'm gonna let this pan out here and see what happens. You can see price comes back higher once again, but look at that, it respects it. And as you can see here, eventually price does end up coming back down into those weak low points, as well as it does tap the opening of that bullish fair value gap, just like I mentioned, before starting to see this push higher. Now this gets us into our next lesson, which is intermediate term highs and lows within support levels. So I talked about intermediate term highs when it comes to short-term highs and short-term lows. So what if I told you you can actually classify a strong high or strong low based upon price tapping into a support level? So we can see here that price came down into this fair value gap, and then it started to see this push to the upside, into this fair value gap, and started to see this push to the upside. This is now a strong low because this is a support level. We break that down very easily. So we have a level of support right here, taps into that support and then leaves it. Price should not revisit back down into that level. Instead, when price taps into that support and then leaves it, that's our guarantee that price has found support here, and now we could start seeing a reversal. You can see here that the prior day price was obviously going lower. We had that intermediate term high right there, right? Price respected it, did not break through it, and it came down here. Now that price tapped into this fair value gap and found the support to push higher, I mean into the new day here, which we are currently during the Asia session between the market open, AM EST. When I'm creating a daily buys for the Asia session, my daily buys most likely would be higher prices. Or have we been? Well, during the previous day, we can see that price came lower, tap into this support level, as well as it took out this area of liquidity right here. Tapping into that support level, we see a strong break to the upside. Markets, my main emphasis is, hey, we came down into the support level and found support. Not anticipating price to come back down here. Instead, if we can see maybe a pullback, I would like to take a trade within that pullback to continue going higher. I draw on liquidity, just a most recent high. I'm going to go down to a 15 minutes time frame because the Asia session is just about to open up. We can take note of a few things. So obviously we can take note of this first fair value gap, take note of this second fair value gap right here. You're in a situation to where obviously you have multiple fair value gaps, this first and second one. This is how you break it down. I want to take note of the 50% of the first one, the 50% of the second one. When it comes to this second fair value gap, price does not come at or below the 50%. In this case scenario, I want to take a long within this first fair value gap, put my stop loss at the 50% right there. My entry right here at the 50% of this fair value gap. And as long as I put my stop loss right here at the 50% of the lower fair value gap, I should be safe. So I created a completely free video when it comes to mastering fair value gaps. The link towards the end of this video so you guys can watch it right after. This is the Asia session. I'm only going to be aiming for a 1.5R, right? Just being very conservative, knowing that the Asia session usually has lower volatility. Price come back within this 50% of the fair value gap, find support to go back higher for a quick scalp. See, price opens up, comes out into that fair value gap right there. You can see price comes back higher right there for a 1.5R. And just like that, perfect. Over a lot of things, intermediate term highs and lows, short term highs and lows, strong highs and strong lows, weak highs and weak lows, exhaustion levels, and then now we have support intermediate term highs and lows. And if you guys got a lot of value from this video and you want to catch trades just like this with me and my brother every single morning, all you have to do is click the first description and join Spark. But if you want more so one-on-one help where I personally coach you to making your first payout or helping you make your first $10,000 trading, then you guys can click the second link in the description and apply to work with me. That's my Spark coaching program where I'm taking beginner or experienced traders and making them profitable within the next 6 or 12 months. So if you want to work with me and my brother, you guys can click that second link and apply. Make sure you guys click the like button, subscribe if you're new to my channel, and comment what you guys want to see next. I'm your mentor, Arkhamtrades. Be safe.